Would you buy a JB condo at 1,500 ringgit per square feet? Well, just about a year ago, it was only going for an average of 1,000 to 1,001 per square feet. What if the JB market suddenly crash after you buy? That's a question many investors are facing right now, because yes, some developers are already planning launches at those price levels. All this under 1 year. So everyone's saying JB is blooming because of the RTS, the special economic zone, the Singapore spillover, and also the cross-border demand. But when prices jump 40% before the RTS is even completed, is this real sustainable growth? Or are we hyping things up before the fundamentals have caught up? So I met some investors who are starting to ask, is this a red flag? In my previous episode, I broke down what's really fueling the JB's rise, from RTS link to Singapore cost of living spillover. But the prices climbing this fast, the question now is, are we looking at real demand, or is it just an early sign of a bubble? And after that video, quite a number of friends have reached out to me to ask if I could compare the JB and KL market side by side. So today we are doing just that, but we will be focusing mainly on JB City Centre and also KL City Centre for today's podcast. So while JB has been grabbing a lot of headlines lately, KLCC remains the heartbeat of Malaysia's corporate economy. It's where the embassies are, where multinational companies are headquartered, where top professionals live, work and rent. That's what gives KLCC one of the strongest, most stable rental ecosystem in the country, especially for long stay expats and business travelers. So right now, these are the two hotspots investors are watching. KLCC, a matured, proven, anchored by global firms and expat demand. JBCC, rising fast, Singapore influence and riding on future infrastructures like the RTS and data centers. So in this episode, we'll break down side by side who actually stays and rent in this area, what kind of rents you can expect, full units, room rental or Airbnb, what's the long-term upside and what are the risks, and most importantly, if you could only pick one, which market makes more sense right now? Welcome back to Ray's Property Market Review, and in episode 2, we are putting JBCC and KLCC head to head. Let's get into it. Just this year, launch prices at projects like Causeway Square, Genstar, Coronation Square have jumped from 1,002 to as high as 1,004 per square feet, and that's just within a few months' time. So what's driving this momentum? Firstly, the RTS link is finally taking shape. It will be a 6 minutes ride from JB to Woodlands North, and once it's running by end of 2026, it is expected to handle 380 crossings per day. Then there's the SEZ Special Economic Zone. Malaysia and Singapore have now formalized the agreement, and that's attracting tech companies, logistic firms, and digital players into Johor. We are also seeing data center coming into JB as well. In the past year alone, names like Microsoft, GDS, YTL, and Equinix have announced multi-billion ringgit hyperscale facilities across the Tenants, Kuala and Nusa Jaya. But as I've covered in my previous video, this won't directly impact the market around the JBCC because of that distance. But just yesterday, there's been a discussion between the Malaysia and Singapore government saying that they are planning to expand the RTS line to other places in JB as well. So what does it mean to the upcoming JB market? And of course, because of the rising living costs in Singapore, more people are choosing to live in JB and commute daily. So when you add it all up, the demand is growing. But the real question is, can it keep up with the supply? Let's break it down. So once the RTS is fully operational, we are looking at a huge boost in daily crossing. Officially, it's designed to handle 10,000 passengers per hour each direction. Assuming it runs from 5 a.m. to around midnight, that's like around 19 hours a day, which works out a maximum capacity of around 380,000 crossings per day just via the RTS alone. Combine that with the existing 350,000 daily Causeway users, assuming that we have two different groups of users at the same time, and we are potentially looking at over 730,000 people moving between JB and Singapore every single day. So yes, rental demand is definitely on the rise, and that's why the developers are moving fast. In JBCC alone, at least 15,000 new units are expected to launch within the next 3 to 5 years. Some developers are already planning to launch at 1,500 to 2,000 ringgit per square feet in JB. Price point that would have sounded unrealistic just a year ago. But here's the real question. Can demand keep with this kind of supply? Because short-term momentum is one thing, but long-term rental sustainability, that's a whole different game. Now, before we answer that, let's zoom into a key question. JBCC has the RTS. What about KLCC? Everyone's talking about what's coming to JB, but let's not forget what KLCC already has. Because while JBCC is banking on future growth from the RTS and the SCZ, KLCC is already firing on all cylinders in terms of location, lifestyles, and real demand. Let's break it down. What KLCC has right now? Firstly, the Petronas Twin Tower, Malaysia's most iconic landmark, but it's more than just a tourist photo spot. It's also a grade A office tower, home to some of the biggest names in the world like Petronas, Microsoft, Bloomberg, Max Hensley, even Al Jazeera. It is also where a lot of multinational HQ are. Companies like ExxonMobil, Maxis, Petronas, Huawei, Microsoft, all rooted here. And then we have the Pavilion Mall, one of Malaysia's most luxurious and busiest mall, a magnet for both local and tourists. And then also the 50-acre KLCC Park, Jalan Allah Changkat Street, KL's most famous street food. And don't forget the TRX, a 70-acre master plan financial hub, already home to the headquarters of the HSBC and Prudential, with more global firms coming in soon. And it is all connected by 3 major rail lines, namely the MRT, the LRT, and also the monorail. So think about it, no matter where you are coming in from the Klang Valley, there is always a direct line into your investment. Compare that with JBCC, which is still figuring out traffic planning and access route for the RTS. So the question is, would you rather bet on what's coming or invest in something that's already proven? So after understanding what each market offers, the next question we need to ask ourselves is this: who are actually staying or renting in JBCC versus KLCC? Because at the end of the day, your tenant determines your cash flow. Let's start with KLCC. Most tenants here are long stay, expat, corporate professionals, and embassy staff. Some buyers even treat it as a holiday home or a trophy asset. So basically what they want is clear. They want privacy, convenience, and premium service. That's why luxury condos like Pavilion Suites, Four Seasons, Stan Regis are in such high demand. But KLCC, it's a full unit rental market. The demand for core living, or we say room rental, is very low. And while KLCC is known for long-term tenants, short-term rental are also thriving in projects like the Face Suites, Scarlet Suites, and Salon Suites, thanks to the steady demand from tourists, business travelers, and short-term expats. But what really sets KLCC apart is that even with new launches, tenant quality stays consistent. So you are not just betting on infrastructure or future growth, you are buying into a location that's already established, proven, and globally trusted. Now let's shift over to JBCC. Different city, different crowd, and very different rental behavior. Unlike KLCC, the majority of tenants here aren't expat or corporate professionals. Instead, most renters are people working in Singapore who live in JB to save on rent, food, and daily expenses while earning the Sing dollar. There's also a growing group of Singaporeans booking weekend stays, especially via Airbnb for shopping, dining, and short family trip. While some Singaporean retirees do choose to settle in Johor, most prefer landed homes or low-density neighborhoods rather than high-rise condos near the CIQ. So what does this mean for investors? JBCC's rental demand, it's very much income-driven, built on cost-saving, conveniences, and border access. It's not so much about luxury and brand value, it's about proximity to Singapore and whether your unit fits the commuter's lifestyle. So let's break down the rental performance and the ROI of both hotspots, starting from long-term rental and then diving into the Airbnb returns. So now let's look into the KLCC market. So in KLCC, long-term tenants are usually expats, embassy staff or corporate professionals. So they are high-earning individuals who stay for work assignments or diplomatic postings. For example, Pavilion Suites, a 2-bedroom unit here typically rent for around 12,000 per month. That's around 144,000 a year. So on a 3 million units, that gives you a gross ROI of around 4.8%. But investors aren't just chasing yields. They are also buying into capital preservation, prestige, and a stable tenant base. In KLCC, tenants expect privacy, top-tier security, and full-service living. That's why luxury residences like Pavilion Suites, the Kyliez, and Regis are built around full unit living, not room-by-room rentals. So it's a different kind of product and different kind of rentals. So over in JB, the rental landscape looks very different. A 2-bedroom unit at R&F Princess Cove typically rents at around 3,000 every month. That's around 36,000 in a year. And on the unit costs about 850,000. So your gross ROI comes up to around 4.2%. But here's where JB stands out. You can optimize it by renting out the rooms separately. So say 1,003 for a middle room, 1,006 for a master room, and then it could bring you in around 3.9k or more, pushing your ROI to around 5.5 to even 6%. So that is also why the room-by-room strategy is common in JB, especially for units near the CIQ where tenants are usually Malaysians working in Singapore. So in KLCC, short-term rental unit perform consistently well. A studio unit renting at averagely 250 ringgit per night with a peak of 600 to 700 ringgit during major events, and let's say 22 nights booked per month, brings in around 5.5k per month in revenue. So after deducting the cleaning, management, and utilities, net income lands at around 3,850 ringgit per month or 46,200 ringgit annually. So that's a net ROI of 7.7%. So what's driving this, right? KLCC draws a lot of global travelers and business travelers. Most units are run by professional operators, maintaining high occupancy rate, strong reviews, and premium pricing year-round. And while 22 nights per month is a norm here, a few strategically located projects are consistently achieving 25 nights or more, pushing the net rental ROI to 8 to 10% monthly on a stable recurring basis. So if you are wondering which projects in KLCC are pulling those numbers, you can click the link below. Our team will send you the data and let you explore from there. Over in JB, studio units also do well, but slightly differently. The target market here includes weekend travelers from Singapore, digital nomads, and cross-border workers. So let's say with similar rates of 250 ringgit per night and occasional peak of 500 ringgit, but a lower average of 15 nights booked per month, monthly revenue is around 3,750 ringgit. So after expenses, you are left with about 2,625 ringgit per month or about 31,500 ringgit every year. So the net ROI is around 5.2%. Still acceptable, but it's more volatile, especially during weekdays. The JBCC Airbnb tend to spike on weekends but dip during off-peak periods. JBCC's long-term rental comes with potential, but it's also a bit of a bet. If everything plays out, the RTS completes on time, rental demand soar, and commuter traffic explode, then yes, there's a chance you will see capital appreciation alongside with rental income. But if demand doesn't catch up quickly enough to absorb the huge incoming supply, we could see downward pressure on prices, at least in the near term, until eventually the demand overtakes the supply. And here's one more thing to consider. What is your exit strategy? If your plan is to hold long term just to collect rental, then great, you can hold it up. But if your goal is to sell later, so the question becomes who's going to buy from you and at what price? Because right now, subsale transactions near the CIQ are still hovering around 800 ringgit per square feet. So if you're buying in at 1,004 per square feet or more, you need to ask yourself, will future buyers really be willing to pay 1,005 or 2,000 ringgit per square feet from you in the resale market? What do you guys think, right? Feel free to share with me your thoughts in the comment below. Now contrast that with KLCC. In the KLCC market, the latest subsale transactions are still holding strong at around 3,000 ringgit per square feet, and I hear say lately there's one going for nearly 4,000 ringgit per square feet, but that's a really premium one. While many of the new launches are averaging close to around 2,000 ringgit per square feet. So instead of buying above the market like in JBCC, KLCC buyers today are often entering below the historical peak, which adds a level of downside protection. So who's buying here in KLCC? Around 70% of buyers here are investors, both local and international. They are mostly looking for a stable trophy asset with strong rental appeal or long-term capital security. So the remaining 30% are buying for lifestyle reasons, whether it's for a holiday home, part of a global property collection, or simply for the prestige of owning in KLCC or Bukit Bintang. So who's really buying in JBCC today? I have actually asked a few friends of mine from JB and also some colleagues there. Most local Johorians, they won't buy there at that price. So it's mostly Malaysian working in Singapore or Singaporeans who are buying in near the CIQ area right now. Now, if we compare that to KLCC, where buyers are from Hong Kong, Singapore, China, Dubai, Canada and beyond, and of course local Malaysian, these are seasoned global investors. So ask yourself this, would you rather bet on a commuter zone or a world-class address backed by international demands? So what's the takeaway? KLCC's Airbnb delivers higher net ROI, driven by steady weekdays demand, international traffic, and premium rates from business and leisure travelers. JBCC has yield potential, especially with room-by-room strategies, but it's more hands-on, more price-sensitive, and more exposed to market shift. But here's what you really need to ask yourself. In KLCC, some subsale units are already transacted at around 3,000 ringgit per square feet, while new launches are entering at around 2,000 ringgit per square feet on average, meaning you are buying below the benchmark and not above it. In JBCC, some developers are already launching at around 1,004 per square feet, but actual subsale prices near the CIQ are still around 800 ringgit per square feet. So if you are buying it at around 1,004 per square feet in JB today, but the actual transacted subsale is only at around 800 ringgit per square feet, how long are you willing to wait before someone is willing to pay you more than what you have paid? And what if they don't? So now let me throw the question back to you. If it's your money, would you go for KLCC or JBCC? There is no right or wrong here. It all comes down to your risk appetite, your holding power, and the play you're after. In the upcoming episode, I'll be diving deeper into the KL and Klang Valley property market. So if there's a specific area you are curious about, feel free to drop it in the comment below and I'll make it happen. Once again, thank you for watching. So if you found this video helpful, a like and subscribe would really mean a lot. It shows me that this kind of content matters to you and encourages me to keep sharing more. Until we meet again, ciao. Oh, by the way, if you are eyeing a KLCC or JBCC property but afraid of buying the wrong project, we have got you covered. So I put together a full KLCC project webinar, same goes with JBCC, walking you through every major projects in KLCC, Bukit Bintang and TRX. So you get breakdown of the location, price, rental return and more. I'll leave the link in the description below, so for those of you who want to know more about properties options in KL City Centre, feel free to click onto the link.